Welcome to Fintech Daydreaming, the podcast that dives into the world of banking technologies and the ever-changing landscape of fintech companies. We bring you real-life examples from global and local thought leaders, as well as experts working within the financial industry, and seek out the best stories from the front lines of financial services innovation, where dreams of industry pioneers meet reality. Hosted by Pål Krogdal and Ville Sontu. This is Fintech Daydreaming.
Hello everybody and welcome to what is going to be a one-off special episode of Fintech Daydreaming for you. We are interrupting our normal broadcasting schedule to bring you this little public service announcement, little news highlight or emergency broadcast. I'm not quite sure what we want to call it, but Ville and I thought that this warranted a quick little episode from us here. So Ville and I have got together. We're going to record this. It's going to come out today. So for us, this is a shoot straight through the process. I'm Pål Krogdal, but you know me already. And with me is Ville, and you know him already. But maybe, Ville, you just say hello and good morning. And how do you feel after our late flight from Copenhagen yesterday?
Yeah, hello, good morning indeed. We just flew back from Copenhagen last night and got a bit of a late arrival home due to being delayed for 1 hour. But yeah, what we did decide while we were waiting for the plane is that we need to do our first emergency podcast now. So being inspired by actually the podcast Hard Fork, they had this emergency podcasting about DeepSeek AI back in the days, and it became a bit of a fun meme across the podcasting world. So of course we had to ride on this same meme now and do an emergency podcast on this very hot item that we just got on our hands yesterday on the 25th.
Exactly, yes. So yesterday being the 25th of September, it's now the 26th of September. You see, that proves how quick we are. Yesterday morning, 25th of September, an announcement went out that said 9 European banks have joined forces to issue a MiCA-compliant euro stablecoin. And you know us here at Fintech Daydreaming. The minute you say blockchain, that's been ticked in this article. You say stablecoins, ticked in this article. You say crypto, you say digital assets. Ville and I have a tendency to come out with some points of view on all of this. And this has exploded. I have to admit, we were trying to record interviews yesterday at the Nordic FinTech Week, but all of the channels that we have exploded. That would be LinkedIn, it would be internal communications across the board. It was just non-stop. What does this mean? What is going on? Is this big? Is this not big? And we thought that we'd sit down and just give you our perspective on this, because I think to a certain degree it's being a bit blown out of the water. There are certain individuals that are getting very excited about this, and there's others like Ville and I who are sitting here and saying, well, maybe we should just step back a little bit, think about this and look into what's going on. One of the interesting things for this, obviously both Ville and I being sitting in the Nordics with a very focus on the Nordic banking market, is the fact that 2 Nordic banks have become part of this joint venture. At the moment, that is Danske Bank and SEB. To me, one of the interesting points in this is both Danske Bank and SEB are actually sitting outside of the eurozone as such. They are supporting Swedish krona, Danish krona, and obviously a European stablecoin is going to be a stablecoin, we assume, tagged to the euro and not to the Danish krona or the Swedish krona. So that's an interesting part to this discussion. But I actually think I want to step right back. To me, there is no one in this world that is more experienced to talk about this than my good friend Ville. So Ville, just for our audience, what is a stablecoin? We discussed this for hours on the flight last night, but what is a stablecoin?
Yes, indeed. Before we start, I do have to give a disclaimer, as I work for a bank in the Nordics, that the opinions in this episode are entirely my own, and indeed opinions and views are always my own on this podcast, and specifically true for this episode. So just need to get that clear, that views and opinions are my personal ones and not necessarily reflecting the ones of my bank. But yeah, good. Let's start with the basics. What is a stablecoin? Well, the history of stablecoins is almost as long as the history of cryptocurrencies. The emergence of stablecoins started when the Ethereum blockchain started back in the days, because and the reason why stablecoins happened then is because Ethereum had a very specific feature which allowed private institutions and individuals to issue their own coins, their own tokens on the Ethereum blockchain. This, of course, famously is not true for the Bitcoin blockchain, at least not back then. Ethereum really allowed this flourishing of new types of tokens. So what was the problem that stablecoins were trying to solve back? This was like in like 2015 and earlier even. Was the fact that many of these crypto companies were not able to get access to regular banking. So getting basically real money in and out of the crypto ecosystem proved to be very hard. And especially if you found a trading place for crypto and for buying and selling crypto assets and then kind of day trading on these markets, the coming in and out of positions on different kinds of crypto assets was very cumbersome if you needed to do the cash leg every time when you did that. So stablecoins address this specific issue. So what you do is you send real money into a real bank account somewhere of a private institution. The private institution receives that money and then issues equivalent value of tokens on a specific blockchain that happens to be in question. Like I said, typically Ethereum or Solana. And the idea is that for every let's say, for example, US dollar you send to the issuer, you will get a $1 equivalent token on the blockchain. Now, the actual money, of course, stays with the private issuer. And there are many of them, of course, around the world these days. For example, we have Circle, we have Tether, many others are available. But these companies, again, give you a stable coin denominated in US dollars, for example, and then you're able to go to these crypto markets and then buy cryptocurrencies or trade cryptocurrencies by buying them with these US dollar equivalents. And then when you want to exit, you kind of go back to the token, so you get the US stable value in case you don't want to be exposed to any crypto speculation or volatility, for example. So it was a kind of a replacement for banking connections back in the days. Now, a lot of time has passed since that beginning of the stablecoin world, and now what we're seeing is that we're seeing regulation coming up in Europe and US, for example, that allows banks and payment service providers and other regulated institutions like e-money institutions to be issuers of stablecoins on public blockchains. Technically, they could have done that before, but because there was an absence of rules and regulations, it was very difficult for regulated institutions to be part of these public blockchains. Now, there is a kind of a roadmap with this regulation that allows banks, for instance, to issue their own stablecoins on the blockchains. So that's what's happening here as well. So we have the 9 banks that are part of this consortium or joint venture that came together and decided that this joint venture will now will in the future issue euro-denominated stable coins on public blockchains. They actually did not define which blockchains, or indeed is it just one blockchain, but the idea is that they will now issue these again MiCA-regulated stable coins in Europe using euro denomination. Yeah, so I'll just leave it there, and I mean there's a lot of kind of things to unpack here, of course, but I'll just leave it there for the definition. Do you agree on that, Paul?
I think I agree with that definition. It was a very detailed and well laid out definition you had there. So yes, I'll agree with that. I think one of the things that we discussed yesterday as we were heading from Copenhagen back to Helsinki was the key element of a stable coin, like you pointed out, is that it's supposed to be connected one-to-one with, either a fiat currency, or it could be gold or something else. And therefore you always should be able to assume that one stable coin or euro stable coin will always be the equivalent of €1. but actually that fluctuates a little bit. We had that discussion on exchanges. So it becomes an interesting dimension of how stable or unstable is a stable coin. But that's a mute point in this discussion. I think what we really want to get to is, what is the implications of these banks getting together and doing this? Does that mean that they are going to create their own little world? Is it going to be a ring-fenced world with their own stable coins? What happens if you get some of those stable coins? I'm assuming here that what they're focusing on is not the retail space. This is really much for corporate capabilities, not for individuals like you and me. So I don't think we're going to have you and me running around with their stable coins. But what happens when their stable coins end up outside of their joint venture?
Yeah.
Does there have to be a way for the stable coins to get back in? And does this mean that actually there'll be multiple bubbles of banks creating stable coins? And then we'll get on to the discussion later about how this relates to the US dollar stable coin, but let's start there.
Yeah. So again, in a way, when we have these multiple issues of stable coins now on these public blockchains, we are creating a world where every consortium, every institution, and potentially even every bank will issue their own coins into this public infrastructure. And these coins are not automatically exchangeable. Funnily enough, if you go back in history to the 1800s, for example, in the US, you had the wild banking era where every bank was issuing their own physical cash. So you had, like, I don't know the names of the banks back then, but let's say you would have like Citibank cash, and you would have JP Morgan cash, and you would have Silicon Valley Bank cash, all as separate and different looking cash notes. Everyone, of course, saying that it's worth a certain amount of dollars. Now, the problem with the wild banking era, of course, that it kind of all crashed when people started to set different values for different banks issued dollars. So again, based on how much you actually trusted and how the public trusted that institution, the value of a $100 note was anything between $80 and $110 for as an example. So this was a problem. When a dollar is not a dollar, you lose the peg, you lose the trust in the system. And funnily enough, the end result of that wild banking era was actually central banking. So now central bank guarantees the value, and that's why we have a system where the banks are the ones who are regulated by central banks, and the value of a euro or a dollar is guaranteed by this mechanism and the regulation and supervision that comes with it. Now, stablecoins are looking to repeat history in that sense, because again, if you have euro stablecoins and dollar stablecoins from different institutions, they actually vary already in value, the discussion we had yesterday. So the market defines the real value of that. And that means that a euro stablecoin might not actually be worth a euro according to the market, based on a little bit on how much is being trust is placed there. Now, but that aside, there's a lot of questions on that are unanswered in the press release that we saw yesterday about this consortium of banks. We know why. We know the banks, the 9 banks are of course listed, and from the Nordics especially, it's quite interesting to see SEB and Danske Bank being one of the 2 of the founding banks. Other large ones are of course ING. We have UniCredit, CaixaBank, Raiffeisen here as well, including Banca Sella and DekaBank. The name list is impressive, but it's not all encompassing. There's a lot of big names missing, of course, from this list, but I think it's still an impressive group for sure. The things that they don't address in the press release, and I'm sure they already have plans for this, but they're staying vague on the public communication at the moment, is that what actually is the leading use case that they would see this stablecoin being used in. So that's the number one question that I have, because if we again come back to where are stablecoins mostly used these days, it is crypto trading, and to a certain extent it's also access to US dollar liquidity in countries where it's otherwise difficult to get access to US dollars. So for example, in South America, you have hyperinflation happening in certain countries. In those places, if you have easily a way to purchase USD stablecoins, then that is a safer bet for your wealth than holding on to the national currency. And these countries typically also limit access to foreign currencies because of the they want to protect their economy. But stablecoins make it possible to do it anyway, so kind of bypassing these controls, and that's of course a growing use case as we see at the moment. Now, what does the European stablecoin aim to address these markets? I don't know. There's no direct mention of what actually is the use case. There are some hints of things like cross-border payments, programmable payments, improvements in supply chain management, and digital asset settlements. None of which are elaborated. So and how exactly is that going to happen? And I mean, based on my understanding, these are, of course, potential and aspirational things that are fantastic if they actually start working. But that takes coordination of multiple institutions, multiple regulations, and indeed somebody to build those networks that actually don't exist today outside the crypto ecosystem. So a lot of promises, a lot of potential, I would say, for sure, but little in terms of actual facts on how things are going to get done as we speak right now. The last thing I want to mention here is the schedule. So they made the press release now in September 2025. They're already saying that the first potential issuance of these stable coins would be towards the end of 26. So we will still have to wait for these things to actually go into motion and them to actually build the joint venture to facilitate all of these things. I believe that they also mentioned that they are looking for a CEO or the hiring of the CEO is still in progress, even though they're saying it's very close to be finalized. So again, very, very interesting, a lot of big words, but little in terms of actual content.
Yeah, they do say here as well in the announcement that I picked up from CoinDesk is that they are setting this up as a new company in the Netherlands, and they are aiming to be licensed and supervised by the Dutch central bank as an e-money institution.
Yeah.
Right. One of the things that I'm thinking about here again is this is a number of private financial institutions that have got together and are creating a stable coin for the Europe market, right? It's a European or Euro stable coin. Would there be a difference if this was being done by the ECB?
Absolutely. I mean, ultimately, the trust towards the central bank that's the ultimate trust anchor, if you will. So I would presume that if a central bank would be doing this, of course, then that would be very disruptive in terms of the availability of central bank backed tokens or assets on a public blockchain. Now, it's good to also note that, again, they are forming a new legal entity, a new joint venture outside of the banks who are participating in this. So it kind of creates them a moat against a lot of the risks, for example, that are potentially arising from the fact that you're working on public blockchains, and but also gives these participating banks a really good position to jump in faster because, again, they are part of it, but they still have this firewall between their day-to-day business and payment flows should something go wrong. And what could go wrong, actually? It's and these are also some things that we don't know at this point in time. We will see how they do it, but there is a question, for example, how do you identify the individuals and companies who are holding and transacting with your stablecoin? The basic premise of wire transfer regulation and being able to be compliant with the AML and CTF regulations is to know the participants in any given transaction. Overcoming this, of course, is possible, but when you do it, what you end up doing is you're doing a whitelist approach. So, for instance, if you recognize which wallets are KYC'd in one way or the other, and then you only allow transactions for those whitelisted wallets. This is the model that, for example, JP Morgan is doing with their own JP Morgan dollar stable coin. Should I call it tokenized deposit, maybe? But and this is a very effective way of solving the problem. But it also does one thing, which is that you will lose most of the transaction volume because there will be very few people who are interacting in the crypto or the DeFi world that would be willing to actually do this. There are other options available that have no controls. So it's very hard to see how this approach would gain any kind of momentum in those circles especially. It also eliminates the other big use case, which is the access to foreign currencies in countries where you might have problems with your own currency. Because again, if you have set the KYC requirement, it automatically eliminates the possibility to access any of these markets, for instance. So that raises the question, okay, what maybe they do a blacklist approach instead. And again, these are things that we do not know at the moment. So the blacklist approach is where you are basically following the sanction screening and the other type of financial crime related lists and analytics from the blockchains, and then you block certain wallets as soon as they are identified to be not compliant. The problem here, of course, is that you're still exposing yourself to a lot of risk because these lists are, while effective, are nowhere near complete. So because if you don't know, you only know the pseudonymous addresses of these wallets, you don't know who's behind them. Even though if you're running this forensics and analytics, you're always 1 or 2 steps behind the criminals, even if you pull your coins from these wallets that are being blacklisted, for example. Is that enough for a compliance approach, for example? I don't know. Probably not, I would say, due to the KYC and wire transfer regulation requirements, but time will tell. Be as it may, it's going to be extremely fascinating to follow the journey that this consortium and also other stablecoin issuers take in solving these compliance gaps, I would say. And it's also good to say that even though this is the first fully bank-owned consortium or JV to issue stablecoins in euros, there are other euro-denominated stablecoins issued under the MiCA regulation already in existence. We already have those things. That is not a unique feature. What is actually interesting is the fact that even though these coins already exist under this regulation, the usage of euro stablecoins has been minimal. I think it's 99+% of the entire stablecoin volume globally is done in USD. So, and then other currencies are absolutely microscopic compared to USD. So it's not even close to being proportional to the euro area economy size compared to US. So again, euro is a very, very small player in this world, because USD is the one that seems to be in demand right now. So again, will this new JV be able to crack this and increase the relevance of euro stablecoins? Remains to be seen. But again, we are at early stages of this, and that's why it's difficult to make any judgment at this point in time. There's just too many open questions.
I think one of the big open questions, which is the one that kept popping up yesterday across all of LinkedIn and everywhere else, is, do we need this? Do we need stablecoins? And there are arguments on both sides of the table. They tend to end up on, well, it's low cost, it's instant settlement, it's easier for cross-border. But based upon what you just mentioned, I'm also wondering at a flippant level, is this the banks just saying, hey, we've run out of other products to sell and monetize, here's something new for us to try and sell, rather than actually looking at this in more holistic views? It's just something new, and FOMO has taken over because the US is trying to drive a whole new stablecoin market.
Yeah, I mean, maybe we had a really good conversation about stablecoins with Tony McLaughlin on the first episode of this season, and he was basically saying that look, there's no harm in you for actually just being in this game. So just in case this actually happens, and he definitely believed that it will happen, that there's going to be some kind of a flippening moment where everything turns into stablecoins. And if indeed that happens, then you need to be ready. So in a way, doing a JV approach of this kind is kind of hedging your risk in terms of making sure that you are in a good position if this really takes off. And I can certainly respect, and I think a lot of the discussions and decision making in these banks when investing into this has gone along those lines. It's basically saying that, okay, yes, we might not have a clear business value here today, but since the opportunity is there, and this is the best play we can do in order to be able to access this potential new world, then might as well do it. So it does seem like a lot like this. Let's just throw things at the wall and see what sticks. And if nothing sticks, then nothing too much lost either. So yeah, again, a smart move from that perspective, and also explains perhaps the absence of real substantial use cases in this announcement.
I think we've dived deep enough into this, so we can close this all off and end the episode. But from my perspective, just to round up, and I'll give you a chance afterwards, Ville. I came into this, if we go back in history, I've been very negative towards the view of crypto, digital assets, that whole Bitcoin world. I am still on the fence. I am not 100% convinced that the future is based around stable coins and digital assets. I believe we're going to have tokenization of things continuing to grow. How that aligns up with our existing monetary infrastructure and financial backbones still remains to be seen, particularly with things like central bank digital currencies coming along and those sort of things. I can understand why some of the banks are saying, hey, let's put our finger in the pie here and do something. If I was sitting in a bank, would I tell a bank to do this now? Probably not. I would probably say, let's sit and watch and wait and see a little bit longer what's going to happen. But I can understand why banks like Danske Bank and SEB have decided, hey, let's do this. It also is potentially very good from a branding perspective and a marketing perspective. So, hey, why not? But I still remain cautious about this growth of stable coins. A lot of the things that are being published as benefits of stable coins, I actually think we already have today if we look at SEPA instant payments and some of the other things. So I'm on the fence, but interesting announcements, and I will follow this very, very closely and see where this develops and continues going.
Yeah. And for the record, I'm also very much on the fence. I tend to always take the contrarian point of view depending on who I talk to. So, for example, if there's somebody very pro something, I would rather bring the conversation back by being a little bit contrarian to that point of view, and then same the other way around. If somebody is extremely skeptic about something or very negative about something, then I'd rather be on the positive side of the conversation in order to bring some kind of consensus or objective view in the middle. But being in the middle by myself, myself being again on not negative or positive about this, I just want to kind of really objectively look, what is the value here, what is being created, what is the actual thing that we're delivering with these new types of things, and then make up my mind based on those outcomes rather than making a kind of a predefined position that I believe that the world is going to be very different in like 10 years. We don't really know that. Anybody who tells that they know are probably delusional or lying. So again, it's good to kind of keep a level head and look where this thing is going. One thing is only for certain, which is the fact that this is extremely interesting. I love every day of working in this space. There's never a lack of drama or new things happening, and I just absolutely love everything that's going on. In despite of where it might go in the future, it's going to be running on private stable coins. Are we going to be running in a world of central bank digital currencies? We don't know. All we know, it's very, very, very fascinating.
So that's it. That's the end of this. We hope that this will spark off a good discussion on all of our channels. Do you believe the future is going to be dominated by stable coins? Or do you think stable coins is just a hype and will disappear? What's your view on this announcement by these banks, these 9 fairly large European banks? Are they doing the right thing? Are they doing the wrong thing? Is this the right time, the wrong time? Join the discussion down underneath. Let us know what you think. We will gladly be a part of that discussion going forwards, but we'd love to get your view on this announcement and what is happening in this space. As always, do a share, do a like, do a subscribe. We think it's wonderful that you are following us here on Fintech Daydreaming. And we will be returning to our normal schedule. Our next episode will be from what we recorded the last 2 days at Nordic Fintech. No, it wasn't. It was at Nordic Fintech Week.
There we go.
There's too many different fintech things going on, right? But until then, this has been Fintech Daydreaming.
This is Fintech Daydreaming.